They could describe everything with one single word. You know, like...
All right, today we're going to try and solve a real Wall Street head-scratcher. We're talking about Spotify, you know, the undisputed king of audio. And yet, its stock has been taking an absolute beating. We're going to use a fantastic deep dive report from research to figure out what is really going on. So let's jump right in.
I mean, it's a genuine paradox, isn't it? Spotify completely dominates global audio streaming. They have more than a third of all the paid subscribers on the planet. And yet, the very people whose job it is to invest have been just hammering the sell button. What is the deal?
And this chart, wow, it tells you everything you need to know. Line, that's the S&P 500, just chugging along, climbing steadily upward. And the blue line? Yep, that's Spotify. You see that dramatic peak, and then this steep 34% drop since the middle of last year. It's this huge gap that has investors totally spooked.
Okay, so first, let's break down the official story. You know, the common fears that have been fueling this sell-off. What exactly is the bear case against Spotify?
So, this bear case really boils down to 4 big worries. First up, the looming threat of AI, right? Could it just spawn a ton of new, cheap competitors? Second, you've got costs going up. Are these new deals with music labels going to squeeze their profits dry? Third, the old hype factor. Did the stock just get way too expensive way too fast? And finally, there's this feeling of, well, disappointment. Were those recent price hikes really enough to move the needle?
Now that's the story you're going to hear on the financial news channels. Research? They decided to look right past those headlines and dig deep, I mean really deep, into Spotify's books to see if that bear case actually holds water. And what they found, well, it forms the foundation of a super powerful bull case. They're basically arguing that the market is missing the real story entirely. Let's take a look at their first key finding. This number right here is the first major clue. Research is projecting that in 2026, the average amount of money Spotify makes from each user, what they call ARPU, is going to grow by 6.7% year over year. So how in the world do they get to that number? Well, they're projecting that the recent price hikes are going to hit 80% of all of Spotify's premium subscribers. Now, this flies directly in the face of that idea that Spotify's pricing power is weak. In fact, analysis says it's actually a huge driver of their future revenue. But wait, there's more. Okay, now we are getting to the absolute core of the analysis. This is the part of Spotify's business that believes Wall Street is just completely, totally ignoring. It's what we're calling Spotify's secret weapon. But to get it, we need a quick definition: gross margin. Don't worry, it sounds more complicated than it is. Just think of it as the profit Spotify makes on every single subscription before they pay for things like marketing or research. And for Spotify, the biggest cost here, by a mile, is the royalties they have to pay the music labels every time you stream a song.
Okay, now here's where it gets wild. For a regular, music-only subscription, Spotify's gross margin is about 35%. Not bad. But for their bundle, the one that includes audiobooks, that margin shoots up to a massive 78%. It's a whole different ballgame. It's an incredibly profitable business. And here is the proof, the smoking gun. This chart is tracking Spotify's incremental profit margin. See how it's just hovering around that 35% mark? And then boom, right after they hike the price on that audiobook bundle, the margin just explodes. It nearly doubles. This is that hidden profitability engine firing on all cylinders. So, the next logical question is how much of a price hike needs to come from this super high margin bundle to actually make a difference? And the answer, according to math, is surprisingly little. Just look at this chart. It's just a tiny sliver of the whole pie. That's right, it's kinda nuts. By just allocating a tiny 12.5% of any price increase to that high profit bundle, Spotify can lift its entire incremental gross margin from 35% all the way up to 40%. It's an incredibly powerful tool for profitability that it seems like the market is just sleeping on. So, what have we got? We have strong revenue growth from price hikes, and we've got this hidden profitability engine in the bundle. So what does this all mean when you boil it down to the final verdict on the stock's actual value? To figure that out, we need one last definition, I promise. It's the price to free cash flow multiple. Okay, don't let the name freak you out. It's just a way to measure how expensive a stock is compared to the actual real cash the business is bringing in. And a lower number, well, that can mean the stock is on sale. And would you look at Spotify's multiple? After it peaked way up there at 36 times its free cash flow back in mid-2025, it's now fallen all the way down to 26.5.
By this measurement, the stock has gotten a whole lot cheaper.
So you put all of that together, and here is research's conclusion. They rate the stock Outperform. At the time of the report, the price was around $512, but their price target is $710. You do the math, that's a potential upside of nearly 40%.
Now, it is worth pointing out, they did actually revise their target down from a previous high of $790, and that kind of reflects a broader slump in tech stocks. But even with that adjustment, their price target is still incredibly bullish.
And this quote from the report really just says it all. For a company that is the hands-down leader in a growing global market, a valuation of 26.5 times its future cash flow is just too low. In other words, they see a massive buying opportunity here.
So, at the end of the day, we're left with this clear clash of narratives. The broader market sees risk and competition and rising costs, but this deep dive from research reveals a powerful, hidden engine of profitability. So the big question is, which story is going to win out? Is this quiet engine going to get loud enough to finally change Wall Street's mind?